Here is a beginner-level corporate finance manager quiz that covers financial planning and strategy, investment decisions and capital allocation, and cash flow and liquidity management. Let's go. Question 1. The process of aligning financial goals with the company's vision and mission. A. Financial reporting, B. Financial planning, C. Strategic forecasting, and D. Equity financing. The answer is financial planning. Question 2. A financial strategy focuses on A. Daily team meetings, B. Reducing headcount, C. Maximizing shareholder value, and D. Increasing employee benefits. The answer is maximizing shareholder value. Question 3. Which document outlines the company's revenue and expense projections for the future? A. Annual report, B. Forecast sheet, C. Tax return, and D. Financial budget. The answer is financial budget. Question 4. A key element in financial strategy is A. Capital allocation, B. Cost center structuring, C. Location planning, and D. Team engagement. The answer is capital allocation. Question 5. The process of evaluating where to allocate capital for maximum return is called A. Budgeting, B. Equity planning, C. Capital allocation, and D. Revenue targeting. The answer is capital allocation. Question 6. A method used to analyze potential investments by comparing the present value of cash inflows and outflows. A. NPV, net present value, B. Cash flow summary, C. Capital budgeting, and D. Revenue projection. The answer is NPV, net present value. Question 7. Which metric helps evaluate the return on an investment as a percentage of its cost? A. Current ratio, B. Working capital ratio, C. Cash conversion cycle, and D. Internal rate of return, IRR. The answer is internal rate of return, IRR. Question 8. The period needed to recover an investment's initial cost is called A. Break-even margin, B. Payback period, C. Capital recoup time, and D. IRR duration. The answer is payback period. Question 9. Diversifying investments across different assets or industries helps reduce A. Total return, B. Financial growth, C. Risk exposure, and D. Cost allocation. The answer is risk exposure. Question 10. A company with limited funds must prioritize investments based on A. Return on investment, B. Office size, C. Budget department choice, and D. Employee feedback. The answer is return on investment. Congratulations on completing 10 questions. Let's move ahead. Question 11. What does cash flow management ensure in an organization? A. strong hiring policies. B, ability to meet short-term obligations. C, strong brand recognition. And D, good customer relations. The answer is ability to meet short-term obligations. Question 12. A cash flow statement includes cash movements in which activities? A, sales, marketing and HR. B, planning, hiring and marketing. C, operating, investing and financing. And D, training, hiring and auditing. The answer is operating, investing and financing. Question 13. Liquidity refers to A, the company's ability to manage employees. B, readiness to acquire new projects. C, the brand equity in the market. And D, the ease of converting assets to cash. The answer is the ease of converting assets to cash. Question 14. A company that cannot meet its immediate financial obligations is facing A, growth limitation. B, liquidity risk. C, investment dilemma. And D, compliance breach. The answer is liquidity risk. Question 15. The ratio used to evaluate a company's ability to pay short-term obligations is A, gross profit margin. B, fixed asset ratio. C, inventory turnover. And D, working capital ratio. The answer is working capital ratio. Question 16. Which one of the following would improve a company's cash flow? A, delaying vendor payments indefinitely. B, increasing salaries without limit. C, collecting receivables faster. And D, expanding credit sales. The answer is collecting receivables faster. Question 17. Which of the following is a sign of poor liquidity management? A, frequent short-term borrowing to pay bills. B, increasing long-term debt. C, high inventory levels. And D, strong equity reserves. The answer is frequent short-term borrowing to pay bills. Question 18. What is the formula for working capital? A, assets, liabilities. B, current assets, current liabilities. C, cash plus receivables, payables. And D, revenue, expenses. The answer is current assets minus current liabilities. Question 19. Which of the following increases liquidity risk? A, high fixed deposits. B, strong inventory management. C, long collection cycles from customers. And D, efficient procurement process. The answer is long collection cycles from customers. Question 20. Why is it important to maintain positive cash flow? A, to comply with HR policies. B, to ensure operational continuity. C, to expand the customer base. And D, to increase the number of employees. The answer is to ensure operational continuity. How many did you get right? Comment below and subscribe for more.